Hello guys, so let's discuss about the banking sector valuation. And here I won't be discussing about the banking sector ratios per se, like capital adequacy ratios and talking about the different other metrics to value banks or the financial ratios for banks. So I'll be in general talking about the banking valuations, thought processes or some insights that you guys need to keep in mind when you are valuing a bank. So if I just begin with the capital adequacy ratio, so not going towards the formula, the per se is the requirement for the public sector bank is 12% as a percentage of the risk weighted assets, and for private sector banks is 9% as a percentage of the risk weighted assets. So coming towards the valuation part, the one thing that we need to understand that whenever we are valuing a financial sector company, especially a banking company, we always use price to book value multiple. Price to book value multiple is a more essential multiple or a multiple that can give you the true value as compared to the price to earning multiples. And I'll let you know how. Because all those people who are judging the valuations of the banks, be it a public sector bank or the private sector bank, on the basis of price to earning ratio, that might not be the accurate number to gauge the valuation of the bank. Why? Because the price to book value multiple, it tends to take into consideration the price in the numerator and the book value of the assets in the denominator. So book value of the banks is nothing but the loans, correct? And the bank works upon loans. The banks give loans and takes loans, right? And the spread, the difference between the interest rate on giving loan and taking loan is the net interest margin, the NIM. And that is the reason why we are taking the book value, because it is essentially showing what the bank is made up of. The bank is made up of the loans, and essentially that book value component is being adjusted against the provision for doubtful debts or the provision for bad debts per se. So that number is getting reduced by that component of the provision of bad debts. And that is why this book value, which is being used in the price to book value multiple, is a more essential metric as compared to the price to earning metric, because price to earning is just taking into consideration the earnings of the bank or the EPS of the bank. And the second reason is, the earnings are important, completely agreed, but the thing is, the bank might have certain amount of provisions, and since the bank is setting aside those provisions, the profitability of the bank might be lower. So do not just judge the bank upon the lower profitability. The profitability might be lower on account of higher provisions, but the bank is a solid bank. The bank is safe. If some kind of calamity happens, certain kinds of contingencies happen, the bank can survive, as compared to the bank having a lesser amount of provisions, which can lead to higher profitability. So for a bank which has higher provisions and lower profitability, that is, the EPS of the bank might be low, the price to earning ratio might be too high, and that is contradictory. In this case, we can clearly say that the price to earning ratio is not giving a clear-cut indication about the valuation or the performance of the bank, because on one side the bank appears too cheap. Why? Because the provisions are less and the earnings are more. On the other hand, the bank might appear to be overvalued. Why? Because the provisions might be high and the earnings of the bank might be low. So since the earnings being represented by this EPS component being too low, the price to earning ratio might be too high and the bank might appear to be overvalued. In that case, you might want to sell off the bank, right? So that is why price to book value is a better metric as compared to price to earning ratio. And the same logic goes towards the ROE and the ROCE. And further, the same logic we can try to gauge towards the free cash flow to equity and free cash flow to firm. Because whenever we are trying to value a bank, right, we always use free cash flow to equity and not the free cash flow to firm. Again, the logic is that debt is not a source for financing for banks. Debt is a raw material for banks. Some other kind of businesses, apart from the BFSI space, might not require debt compulsorily. There might be firms, there might be some FMCG firms, some IT firms, some capital goods firm. Taking debt is not compulsory for them. The firms might be able to survive the retained earnings, some internal cash flows by raising equity, right? But the bank has to compulsorily raise debt, because that is the main source of finance for debt, right? Because the bank is taking loan and giving out, and the yield spread or the yield difference between the interest on the loan given minus interest on the loan taken is a net interest margin for bank, and that is the spread for the bank that bank is taking into consideration. That is why we're always taking into consideration free cash flow to equity and dividing it by the cost of equity and not the cost of capital or the WACC, because we have all the FCFE over those time periods and dividing it by the cost of equity to get the valuation for the bank. And we tend to calculate the equity value of the bank. right? And also one thing we need to understand, the financing decisions and operating decisions are not separate. It tends to be an overlapping between the two. Correct? So that is one thing we need to understand whenever we are trying to value a bank. Also, sometimes people tend to use a dividend discount model to value the bank. They tend to use those dividends or buybacks, augmented dividends, and tend to discount it by the cost of equity. But one thing that we need to understand is, for a clear-cut valuation, dividends cannot be negative. Dividends can never be negative, but free cash flow to equity can be negative. A bank which is undercapitalized might have FCFE, or free cash flow to equity number, as negative. It might lead to dilution, and the bank might have to raise more equity, right, to finance its operations. So that is one thing we need to understand. Also, one more thing that we need to understand is that whenever we are valuing a traditional company, we tend to calculate the investment amount or the capex amount, right? So the capex for the bank is their investment in the regulatory capital, because they have to maintain those percentage numbers of 12% for public banks and 9% for the private banks, as I just stated you earlier. And nowadays we have seen that different regulations have come up with the RBI regarding gold loans, companies, like some ban upon the loans that they're giving, especially by charging or increasing the risk weights, right, on personal loans and credit cards to 125% and 150% respectively, having some alterations and modifications in provisions for AIFs, right? So all these is forcing banks to keep higher risk weights, because ultimately this will secure the bank's profitability balance sheet and make the bank solid and help them survive in terms of crisis. Right, so that is one thing also we need to understand. Also, there is a way to calculate an implied cost of equity for the banks. And how do we calculate that implied cost of equity? We take into consideration the price to book value for the banks. We equate that number with the return on equity minus the growth rate, divided by the cost of equity minus the growth rate. So get the price to book value number for the bank, get the ROA number for the bank, and get the growth number for the bank. Simple maths, and you'll get your implied cost of equity. So a few ways a few, I would say, points to keep into consideration while you are valuing a bank, and all these points are attached below. Thank you.